Welcome to our 10th video series where we utilize data to inform global policy. In this episode, we analyze the per person growth of public debt, investment and income in 163 countries. The data was obtained from the IMF and the World Bank. The central question is rapidly rising global public debt being effectively used to raise the productive capacities of various economies, and to what extent? If yes, then one would expect to see its positive effects on investments and growth. It may be argued that the impact of debt on investment and growth happens with a lag, and thus we should not expect it to revive the economy, at least in the short and medium run. However, in the long run, we do anticipate that it will rekindle growth. Rapidly rising public debt is a concern, as it may stifle growth and development, lead to state interference in the economy through higher taxes in the future, and thus chain people to the bondage of forced work and lead to crowding out private investment, among other effects. The per person public debt has grown faster than GDP per capita in 96 countries, but at a slower rate in 67 of them. When examining the countries with the largest growth in the ratio of per person debt to GDP per person, we find that Bahrain, UAE, Equatorial Guinea, Bahamas, Finland, Zambia, Ghana, Belarus, and the Dominican Republic have the highest values. The bottom 9 are Congo, Turkmenistan, Syria, Iraq, Honduras, Serbia, Comoros, Bulgaria, and Jordan. Notice that most of these trading countries are politically unstable, and thus their debt figures may be questionable. Moving on to the nations with the highest growth in the ratio of per person debt to investment per person, we observe that the per capita debt has grown faster than investment in 94 countries, but at a slower rate in 69. Kiribati, Thailand, Lebanon, and Japan are among the top 9, in addition to the countries highlighted previously. We can also see the bottom 9 nations in the same measure in the chart. High and prolonged public debts could be a sign of unsustainable fiscal policies, economic mismanagement, or even low productive capacities. Therefore, governments must ensure better debt management policies, for example, by guaranteeing that these debts are invested only in productive areas, increasing the transparency, efficiency, and accountability of the investment project, diversifying and undertaking various structural reforms that raise the overall country's innovativeness and productivity. In this project, we have examined the evolution of global public debt along with investments and income per person. In the next one, we will analyze global school transition rates, that is, primary, secondary, and tertiary. Until then, goodbye for now.